the momentum of disinflation strengthened in August 2012. Annual headline and core inflation fell sharply to 11.9% and 11.5% respectively in August, from 14.3% and 15.4% in July. There was also a sharp fall in annual non-food inflation from 19.1% in July to 16.0% in August, which in the previous month had been relatively sticky. The annual food price inflation had been relatively sticky. Since the beginning of the year, monthly inflation rates have been reduced, with the headline and core inflation rates averaging 0.4% and 0.3% respectively, which is an indication that the disinflation process has remained solid. There are three main reasons for the decline in inflation. First, the food price shocks, which afflicted the economy in 2011, have abated somewhat. Second, domestic demand pressures are weak, with the economy operating below potential output levels. Thirdly, the stability in the nominal exchange rate since the start of the second quarter of 2011-2012 has been translated into stable prices of traded goods. In the short term, inflationary pressures are very likely to remain subdued. The Bank of Uganda now expects that annual core inflation will fall to single digits by the end of September 2012, and then will gradually flatten out at around 5% in the first half of 2013. However, all forecasts are subject to risks. As we move into 2013, there are potential risks of stronger inflationary pressures emanating from food price shocks and other pressure. Global food prices have already begun to increase because of drought in major food producing regions. Inflation pressures may also emanate from the external sector, given Uganda's large current account deficit. Monetary policy will continue to focus on stimulating a recovery in aggregate demand in order to boost real economic growth, while at the same time guarding against any resurgence in inflation. Accordingly, the Bank of Uganda will reduce the policy interest rate, the central bank rate, CBR, by 2 percentage points to 15%. Reduction by 2 percentage points, 200 points. To 15% for September 2012. This reduction in CBR is intended to bring about a further fall in marginal costs of funds for the commercial banks, and hence a fall in bank lending rates, stimulate a recovery in bank lending to the private sector. Unfortunately, despite the CBR having already been reduced by 6 percentage points since February 2012, prior to today's reduction, commercial bank lending rates have not yet fallen in line with the CBR. With the trend towards lower interest rates now firmly established, I fully expect commercial banks to respond more positively and reduce their lending rates to stimulate demand for credit. The ban on CBR will remain at plus or minus 3 percentage points, and the margin for the rediscount rate will remain at 4 percentage points for the CBR. The rediscount rate and the bank rate will now be set at 19 and 20% respectively in September 2012.